and take the discussion on markets, because earnings are also coming around the corner. Vinod Karki is here to discuss that. Vinod, before we talk about sectors, how important is this earnings season going to be broadly on margins and revenue growth front? Let's start our discussion with that.
Hi Ajay, good afternoon. So earnings will be very important, and more than the numbers itself, the commentary from the managements about the near-term future will be more important, because a lot of things have changed from the time this quarter earnings. I mean, the Q2 period, if you see, the July to August, September period, things have changed a lot, and people would be more inclined to see how the managements are seeing things on the ground, and rather than the numbers themselves, right? Because just to give an example, a lot of commodity prices have reduced, have come off, while the demand as we going into the festive season is looking quite robust if you look at some of the high frequency indicators. While the whole of Q2 might not reflect that entirety, because price changes, input price changes take some time for companies. But the management commentary around demand and inflation will be the most keenly watched number. High frequency indicators that we have seen so far indicates that if you look at GST, PMI and all, it seems to suggest that demand going into the festive season is robust, while a lot of commodity prices have fallen off. So that will be a very key thing to look out for the manufacturers, at least, because if you see earlier at the end of Q1, the biggest worry for people was the margin, because the way inflation was rising was the biggest worry, and there were worries on the demand front also. But some of these fears are getting a little bit lower. I mean, demand is looking robust, while a lot of commodities have cooled off, including crude oil, which was not earlier cooling off. It was still above 100. There has been a sharp slump, although it's now stabilizing around that 90 level. So this will be very important rather than just the numbers. But if you just talk about numbers itself, I think banks, the whole of, that's a large part of the Nifty weightage, we'll see good traction, because first of all, if you see mark to market, the bond yields have been flat or slightly lower, I think, for the quarter. So the treasury losses that we saw previous quarter, that will not be there. Plus, if you see the business updates from a lot of these lenders, seems to suggest that the growth is quite good, right? So I think both on growth and the treasury losses that we saw, plus margins, because they have repriced their advances, but the deposits, they take time. So I think banks will do reasonably well in terms of earnings. While for the industrials, I think the key thing to go watched out will be the demand environment and how inflation pans out. That will be very important to see.
Right. Okay, so let's talk about banks a little more in detail. PSU banks have been showing very good traction, at least the last three or four of them. In terms of, in the last 4 quarters, good commentary, decline in asset quality, good loan growth. Do you see PSU pack, the larger ones, continue that momentum?
Yeah, I think, yeah. So if the key thing is, especially for PSU banks, is how the NPA trajectory is moving and how growth is coming along, So everyone agrees on the point that we have kind of forming a bottom on the NPA cycle. So the credit cost issues won't be there much. While quarter on quarter, the growth is looking robust for almost all banks, including PSUs. So, so that I don't think there will be any issue on growth or credit costs, while margins will look good, So I think overall financials are well placed, and the valuations are not extremely high as it is in some of the other pockets. And if you see one theme in terms of stock performance that we have observed from when the COVID hit us in March 20, is that there has been a shift in the performance of stocks, wherein the capital intensive value those kind of cyclical type of stocks are outperforming, even with so high volatility that we have seen across the board. So many events and high volatility that we saw in global capital markets. Despite that, these type of stocks have outperformed, which earlier, if you remember, used to be done by the growth and quality stocks. They used to be continuously outperforming these type of stocks. So I think that's a shift that has happened. And the underpinnings of this shift is clearly the cyclical improvement that we are seeing in the capex cycle, the credit cycle, and the pent-up demand in discretionary consumption that we are observing right now.
Okay, private banks. What about private banks? Do you see the momentum there on loan growth and asset quality improvement continue?
Yeah, so from a top-down macro perspective, what we are observing, as I said, is that it won't be like one. We are not talking about one company versus another. We are seeing a structural improvement in credit growth. So for the month of September, the fortnightly data is suggesting that we are almost 16.7% credit growth, non-food credit growth on a system-wide basis. So I don't think anyone will be left out in terms of credit growth, especially when we are observing the investment cycle is picking up and the discretionary consumption, if you've seen across company sectors, is looking quite strong. I mean, be it autos, retail, travel, across the board, the discretionary consumption is coming back. While we are seeing green shoots of investment and that we have been talking about, plus the real estate, which is a large part of the investment cycle that we firmly believe, it's a large chunk of the gross fixed capital formation, which is reviving after a decade, I would say. So no worries on the demand side on credit growth. Everyone will get its share. You just have to pick your own stocks, basically.
Sure. So, okay, so let me put it this way. Which sector, in your view, will have the best quarter?
Yeah, so what is coming out clearly is banking, very clearly. What is also coming out is that a lot of discretionary consumption is showing good traction. If you look at all the high frequency indicators, the demand for discretionary consumption is quite good. And if they give any benefit of lower input costs on raw material like oil, steel, and other metals, other commodities, the outlook will start looking better, even if it doesn't show up in this quarter, because these arrangements of raw material, procurement, they take time to get showing up on the P&L. So, but clearly, where the demand is coming up in the economy is very clear. It is coming from the investment-led stocks. It is coming from the credit growth side of the economy and discretionary consumption. I think where the weakness is basically, commodities. It's the other side, and they flip the coin. So when you're saying commodities are cooling off, so commodities will be a problem. So basically, the global-oriented, stocks which are linked to global economy and demand in the global economy, they might see weaknesses and weak commentary rather than just the numbers themselves. The commentary around future growth for stocks which are linked to the global economy might see a little muted commentary from the managements. While the ones which are in the domestic economy, I think they will be showing quite robust outlook. So that is how we would like to position ourselves. Domestic, cyclical, capital-intensive sectors where we are seeing good traction, growth, investments, supported by credit growth, are the places to be at this juncture in the market.
Okay, right. Vinod, before I let you go, just one view on the way Dabur, Godrej Consumer commentary came in, Q2 updates. In fact, 15 days back, even Mr. Mehta of HUL did say that full effects of inflation are yet to be passed on. When you say that part of consumer finding it difficult, is this the part you are referring to?
Yeah, so you see, there are two parts to it. So the consumption pattern you have to clearly demarcate into two parts. One is the staples, the marginal. I mean, from the perspective of the consumer. So the marginal consumer who is looking at broad-based products, low price point products. There, I think because of income being not too robust in the hands of the people who are in the informal segment, they might find a lot of hurdles in terms of spending. But in the discretionary, where the formal side of the economy is, and the consumers are from the formal sector, where there has been good wage growth. In fact, new jobs are getting formed over there, and the wage growth is good. That is where we finding traction in terms of discretionary consumption. So that's why this little bit of dichotomy, I would say, in consumption you're seeing, that a lot of this, what you should say, staples type of companies, where where the marginal consumer holds the key, and he may not be in a very good, what you should say, space to consume, against the consumer who are getting wage growth, which income growth is better, and wealth effect is there. I think there. So that's what I mean. If you look at the breakup, houses, cars, other type of travel, leisure, they're saying good growth. But where it's a marginal consumer who is hit by inflation, you're seeing some struggle over there.
Right. All right, we'll let you go on that one. Thanks so much for joining us. One